What we are seeing, Samir, is many central banks are starting to hike interest rates as inflationary pressures start to take a grip on Africa. Has the cycle changed? Is this the new trend in Africa, and is it a good thing?
Yes, I think it's a new trend, although the trend starting in some countries a little bit earlier than that. I mean, in Nigeria, for example, the central bank has been tightening rates since September 2010. In East Africa, it's a bit more recent. For a very long time, the Central Bank of Kenya tried to maintain low interest rates to boost private sector credit. Obviously, it's changed its position, especially in early October when it increased the central bank rate by 400 basis points. So I think, those are very interesting times, and clearly it's going to have an impact on the fixed income space and basically international and local interest in bonds and treasury bills.
All right, so we're starting to see interest rates going up in key African economies, but we're also seeing depreciation of major African currencies. What bearing is that having on the attractiveness of African securities?
Well, the irony is that the two events are actually linked. The central banks are tightening monetary policy because the exchange rates are under pressure. I mean, it was, the clear source of the monetary policy tightening in Nigeria since last year, but we're also starting to see the same trend in East Africa. For example, the Central Bank of Kenya is clearly under pressure because the shilling has weakened substantially in recent months. Less so maybe over the last 2 weeks. Same issue with the Bank of Uganda, for example.
Let's talk about East Africa, because that seems to be the region of Africa most vulnerable to imported inflation on food and fuel costs. That's where we've seen, as you're saying, significant depreciation of currencies, and just recently aggressive rate hikes in both Uganda and Kenya of 400 basis points. But it seems as though bonds are responding differently. The yields are rising, but which are more attractive? Which is a more interesting case for you, Uganda or Kenya?
Well, I think it's a bit tricky. I mean, in both cases, you have an interesting story, but maybe the timing is a bit different. I mean, first of all, both countries structurally have balance of payments issues. They have current account deficits, which have to be financed via capital inflows. But those capital inflows have not materialized over the last 2 years. So clearly, boosting interest rates and yields is a way to attract foreign inflows. Now, the Kenyan market is actually much more sophisticated. So it takes much more efforts to turn the currency. While in Uganda, actually, the size of the auctions is only $30 million. So frankly, if there was any substantial foreign interest, this currency could turn quite rapidly.
The irony or the discrepancy, Samir, if I look at Kenya, for instance, is interest rates are going up. They're going up significantly, but they're not above inflation. And this is the problem here, is for anybody looking at Kenyan securities, inflation is still higher than the basic CBR.
Yes, but in both cases, actually, in Kenya and Uganda, inflation is likely to turn in coming months. We're going to have a very high base effect this year, which should result in lower inflation rates next year. But that said, the condition to achieve those results is that the exchange rate framework is stabilized, because obviously imported inflation could rise further if the currency in Kenya or Uganda continues to be under pressure.
Okay, let's head over to West Africa now. As you say, monetary tightening for almost a year already. A very dramatic move last week, Monday, with 275 basis points. But we've still seen a currency under pressure. How do you explain that?
Well, in Nigeria, the situation is somewhat different. I mean, the country enjoys a substantial current account surplus, but fiscal policy is extremely loose. So until now, the liquidity coming from the fiscal side had negatively impacted the naira. That's starting to change, but the issue now is that we have a segmented FX market where the central bank WDAS FX rate has appreciated, and where the interbank FX market is still somewhat under pressure. So the tightening actually basically, is a function of this pressure, and the central bank wants to tighten liquidity in order to boost the domestic and international bid for the naira. So we have now very, very attractive rates. In fact, I think, those rates, if you adjust for liquidity, are probably the most attractive in sub-Saharan Africa. 18% for the 7-year bond. This is very good.
Attractive rates, good-looking yields, but is there appetite for Nigerian securities? We do know that in a market that's bearish, people have tended to move away from equities into fixed income. But are we seeing capital flows on this side of the market?
No capital flows for now, but I think there is incremental interest. International investors want to have more clarity about the FX stance. If the central bank is able to manage the exchange rate and at least prevent a significant depreciation, I think there will be inflows as global risk sentiment improves or at least stabilizes. But having said that, there are also very significant pension funds in Nigeria, which can make a difference. So I think, as rates move further up or at least stabilize at 18, 19% at the longer end of the curve, they're going to get in and lock in the attractive rates.
Okay, so we've looked at East Africa, we've looked at Nigeria. For you, generally, how do African securities compare to other emerging markets at this time?
I think, frankly, Africa has become extremely attractive. It wasn't the case 2 years ago. There are very, very few countries in the world which can compare to African economies in terms of yields as of now. So it's a very interesting story. Obviously, you don't have the same kind of liquidity as you would have, let's say, in Latin America or Asia or even Eastern Europe. But, even for buy and hold, I think those rates are still quite attractive.